The screech of tires was the first sound, a raw, tearing shriek that ripped through the otherwise mundane afternoon.
Sarah had been humming along to the radio, navigating the familiar route home, when the silver SUV suddenly swerved, a blur of chrome and panic, right into her lane.
There was no time to react, only a sickening lurch, the jarring impact, the crunch of metal against metal, and then the terrifying silence that followed, broken only by the distant blare of a horn. Her world spun for a moment. The airbag deflated against her chest, leaving the acrid smell of burnt propellant hanging heavy in the air.
She blinked, adrenaline surging, checking her limbs, her breath catching, as she realized, miraculously, she was unhurt, just shaken to her core.
Outside, the front end of her beloved sedan, the one she'd meticulously saved for, was a mangled mess, a sculpture of twisted steel and shattered plastic that bore little resemblance to the sleek vehicle she'd driven moments before. "It's completely totaled," the tow truck driver had said, shaking his head with a grim empathy as they hooked up what remained of her car.
Sarah, still trembling but focused on the next steps, had simply nodded, a familiar phrase echoing in her mind. Totaled. Okay.
That means insurance just replaces it, right? It's a complete loss, so they'll cut me a check for a new one, or at least one just like it.
That was the common wisdom, the comforting assumption shared by countless Americans whenever a car met its unfortunate end on the unforgiving asphalt.
We pay our premiums diligently, month after month, year after year, with the unspoken understanding that when disaster strikes, the system will make us whole again.
It's a simple transaction, car gone, replacement provided. But Sarah was about to discover, as so many do, that the reality of what totaled actually means and what insurance actually pays is far more intricate and often far more surprising than the comforting myth. The phone call came 2 days later, not from the friendly agent who'd sold her the policy, but from a claims adjuster, their voice calm and professional, cutting through the residual stress Sarah felt. "Ms. Miller, regarding your vehicle, the 2018 Honda Civic, we've assessed the damage. Based on our estimates, the repair costs approach or exceed its current market value. Therefore, we are declaring it a total loss." The words were clear, concise, yet they carried a weight Sarah hadn't anticipated. Repair costs approach or exceed market value. This was the precise definition, the legal threshold in the United States. Not what you paid for it 3 years ago, not the emotional investment, not even what you still owe on the loan that feels like a lead weight around your neck. Just what the car's worth today on the open market as a used vehicle. And that, Sarah would quickly learn, changes absolutely everything. Her initial relief that the car was indeed totaled, that she wouldn't have to deal with endless repairs and rental cars, began to give way to a knot of unease. "So, you'll be sending me a check for a new car?" she asked, trying to keep her voice steady, forcing a confidence she didn't feel. The adjuster paused, a subtle shift in their tone, a practiced politeness that masked an underlying firmness. "Miss Miller, with your collision coverage, we will be paying out the vehicle's actual cash value. Actual cash value. Another term, another layer of complexity. It wasn't replacement cost. It wasn't the original sticker price. It was, as the adjuster meticulously explained, the current market value of a comparable vehicle, minus depreciation, and then, of course, minus her deductible." Sarah's mind raced. Market value. Her Honda, while well-maintained, was 3 years old, had seen its share of commuter miles, and certainly wasn't sparkling new anymore. Depreciation. That silent, relentless erosion of value that begins the moment you drive a new car off the lot. She remembered reading somewhere that cars lose a significant chunk of their value in the first year alone and continue to decline steadily. And her deductible, $1,000, a sum she'd chosen to keep her monthly premiums lower. The reality was starting to set in. the amount she would actually receive was going to be considerably less than what she had initially envisioned, less than what she felt her car was truly worth to her. The promise of making you whole suddenly felt very conditional, contingent on a specific, coldly calculated figure. This distinction between what a car means to its owner and its cold, hard, actual cash value creates a chasm where many Americans find themselves caught off guard. Sarah, like millions of others, had financed her car, and while she'd made consistent payments, the loan balance had always felt stubbornly high. She remembered the financing consultant talking about negative equity, about how a car depreciates faster than you pay down the loan, especially in the early years. At the time, it had seemed like a distant, abstract concept, a minor detail in the excitement of a new car. Now it loomed large, a terrifying mathematical problem taking shape in her mind. What if the insurance payout, that carefully calculated actual cash value, was less than the remaining balance on her car loan? The thought sent a chill down her spine. The accident had already left her without transportation, but the prospect of being without a car and still in debt for a vehicle that no longer existed, that was a truly frightening realization. This wasn't just about losing a car. It was about the complex financial ripple effect of a totaled vehicle in America, a system where the physical end of a car can be just the beginning of a prolonged and unexpected financial struggle. What most people think happens when a car is totaled in America, that insurance simply replaces it, or at least pays off your loan, is a comforting myth, a hopeful narrative we tell ourselves to soften the blow of a devastating accident. But the true financial reality, the cold, hard mechanics of how a totaled vehicle claim is processed, can be profoundly different, often leaving people not just without a car, but still buried under a mountain of debt for something that no longer exists. This wasn't just about losing a car. It was about the complex financial ripple effect of a totaled vehicle in America, a system where the physical end of a car can be just the beginning of a prolonged and unexpected financial struggle. Let's tear away that comfortable myth and look at what totaled actually means in the U.S., because the definition itself is the first, most crucial pivot point that changes everything. In the American insurance lexicon, a car is considered totaled not when it's utterly demolished, not when it's beyond recognition, but when the cost to repair it approaches or exceeds its actual cash value in the market. Notice those words, market value. Not what you paid for it, not what you owe the bank, just what that exact make, model, year, and condition of car is worth on the open market right now, today. This distinction is absolutely critical. Imagine you bought a sleek sedan 2 years ago for $30,000. It's been well maintained, but it's still 2 years older, has 40,000 miles on it, and the market has shifted. An accident leaves it needing $16,000 in repairs. The insurer assesses its pre-accident market value at $18,000. Suddenly, those repair costs, though less than the original price, are very close to the car's current worth. It doesn't take much for that $16,000 to push past a threshold, an internal percentage set by the insurer or by state law, declaring the car a total loss. The emotional relief of hearing "it's totaled" quickly curdles when you realize the benchmark isn't your investment, but a fluctuating market price. And that brings us to what insurance actually pays when your car is declared totaled. If you have collision coverage, which is typically required for financed vehicles, your insurer isn't paying for a replacement car. They aren't paying what you originally paid. What they're paying is the car's actual cash value, or ACV. This is where the grim arithmetic truly begins. ACV is determined by taking the current market value of your vehicle, again, not what you paid, not what you owe, then subtracting depreciation based on its age, mileage, condition before the accident, and various other factors. And crucially, they then subtract your deductible. So that $18,000 market value we just talked about, if your deductible is $1,000, your payout could be as low as $17,000. That number, the actual cash value after your deductible, is the maximum you'll see from your standard collision coverage. It's a number that for many simply doesn't compute with the idea of being made whole again. Here's where the system truly catches a vast number of Americans off guard, creating a gaping financial chasm. Car loans, especially in the first few years, often exceed the vehicle's actual cash value. This phenomenon is known as being upside down or having negative equity. Why does this happen? Well, cars depreciate rapidly the moment they're driven off the lot. A car can lose 10–20% of its value in the first year alone. Meanwhile, your loan balance decreases on a fixed schedule. If you made a small down payment, financed for a long term, 72, even 84 months are now common, or rolled negative equity from a previous trade-in into your new loan, you are highly susceptible to this. According to Experian data, a significant percentage of new car buyers find themselves with negative equity even before their first payment. Imagine this devastating scenario. Your car is totaled. The insurer, following the rules, calculates its actual cash value at $17,000. But because you bought it 3 years ago with a minimal down payment and a long loan term, you still owe the bank $24,000. That leaves you with a staggering $7,000 financial deficit, a debt for a car that no longer exists, a car you can no longer drive, and a car you desperately need to replace. You are, quite literally, still on the hook for that $7,000 difference, even as you grapple with the emotional fallout of the accident and the immediate logistical nightmare of finding new transportation. It's a cruel, unexpected double blow that plunges many into a financial despair they never anticipated. This is precisely where gap insurance comes into play, a critical, yet often overlooked safeguard. Gap insurance, short for Guaranteed Asset Protection, is designed specifically to cover that devastating financial gap, the difference between what your standard auto insurance pays out and the remaining balance on your car loan or lease. Without it, that $7,000 difference we just discussed, that debt stays entirely with you, the owner. You'd be making loan payments on a ghost, a memory of a vehicle, while simultaneously trying to scrape together funds for a new down payment at a new car. Gap insurance offers a crucial safety net, especially for newer vehicles, longer loan terms, or situations where you put down a small down payment. It transforms a potential financial disaster into a manageable bump, ensuring that once the insurer pays out, your loan is fully satisfied and you can move forward, albeit carless, but critically, debt-free. But what if the accident wasn't your fault? Surely, if another driver caused the damage, their insurance would cover everything, right? This is another common misconception. If another driver is at fault, their liability insurance should pay for the damage to your vehicle. However, here again, the system introduces complexity and potential limitations. Every state mandates minimum liability coverage, but these limits vary wildly and can be surprisingly low. Some states only require $10,000 or $15,000 in property damage liability. Imagine the scenario. The other driver, through sheer carelessness, totals your perfectly good sedan, which had an actual cash value of $28,000. But their policy only covers $15,000 in property damage. You're still left with a $13,000 shortfall. In such cases, if the at-fault driver's liability limits aren't enough to cover the full damage to your vehicle, your own uninsured or underinsured motorist property damage coverage, if you opted for it, might kick in to cover the difference. Or if you have collision coverage, you might choose to file under your own policy, pay your deductible, and then your insurer would attempt to subrogate, or recover, funds from the at-fault driver's insurance. Even when you're the innocent party, the path to being made financially whole is rarely straightforward, often fraught with potential gaps and delays. Once the claim is settled and the payout is determined, the actual mechanics of the financial transfer are equally instructive. The insurer doesn't typically send you a massive check directly. Because there's a loan on the vehicle, the bank or finance company holds a lien on the title. So the insurer will usually issue the payment as a multi-party check made out to both you and your lender. The lender is reimbursed first for the outstanding balance of the loan. If the insurance payout is more than what you owe on the loan, the lender takes what's theirs, and the remaining surplus amount, if any, goes to you, the owner.
This is the best-case scenario, but even then, that surplus might barely cover a down payment on a replacement vehicle.
However, and this is the crucial part that devastates so many, if the insurance payout is lower than the remaining loan balance, the lender takes the full payout, and you, the borrower, are still legally obligated to pay the lender the difference. This is where that financial gap becomes a crushing, inescapable reality. You are now negotiating directly with your bank to pay off a debt for an asset that has ceased to exist, all while navigating the emotional and logistical aftermath of an accident and the urgent need to acquire new transportation. In America, a totaled car doesn't simply end the accident. The physical damage might be cleared from the road, but the financial wreckage can linger for months, even years. It can leave individuals not only without transportation, a crippling blow in a country built around car dependency, but also still burdened with debt for a vehicle they can no longer drive. This isn't because of a catastrophic failure in judgment behind the wheel, or even necessarily the severity of the crash itself. It is by and large because of how insurance coverage works, the stark reality of vehicle depreciation, and the often hidden complexities of car financing. It's a cruel twist of financial fate. Your car is gone, you're potentially without a ride, and you're still making payments on thin air. It's a systemic outcome, born from the rules of the game, one that few people truly understand until they're caught in its unforgiving grip. It's why understanding these intricacies is not just smart, it's essential for navigating the unexpected pitfalls of everyday life in America. The unforgiving grip we discussed, the systemic outcome born from the rules of the game, truly reveals its teeth when a seemingly simple event, like a car accident, turns your vehicle into what's known in America as a total loss. Most people, when they hear that term, immediately assume their insurance company will simply replace their car. They imagine a seamless transition from one vehicle to another, perhaps with a small deductible. But what actually happens financially is often dramatically different, and for many, deeply surprising, even shocking. It's here, at this intersection of perception and reality, that the true complexity of America's auto insurance system becomes brutally clear. Let's begin by defining what totaled actually means in the U.S. It's not about the severity of the damage in a visual sense, nor is it strictly about whether the car can ever be driven again. A car is considered totaled when the estimated cost of repairs approaches or exceeds its actual market value. Crucially, I said market value. This is not what you paid for the car, whether new or used. It's certainly not what you still owe on your loan. It's simply what that specific make and model, with its mileage and condition, is worth today on the open market. This distinction, this singular focus on current market value, changes everything about the financial aftermath. So, if your car is totaled, what does your insurance actually pay? Assuming you have collision coverage, which is usually mandatory if you have a loan, your insurer will pay you the car's actual cash value, or ACV. This isn't the replacement cost. It's not what it would cost to buy a brand new version of your car, or even a similar used one without accounting for its age and wear. ACV is calculated by taking the current market value of your vehicle, then subtracting depreciation based on its age, mileage, and condition, and finally deducting your policy's deductible. Imagine a car you bought 3 years ago for $30,000. Today, it might only be worth $20,000 due to depreciation. If your deductible is $1,000, your insurer would pay you $19,000. It's a sum designed to put you in the financial position you were in just before the accident, not a position to acquire a new or equivalent vehicle without further out-of-pocket expense. Here's where many Americans are caught completely off guard, experiencing the most common and devastating financial gap. It's a harsh reality that car loans, especially in the first few years of ownership, often exceed the vehicle's actual cash value. This is particularly true with longer loan terms, minimal down payments, or when buying a new car that depreciates rapidly.
Because of this, after a total loss, the insurance payout, calculated as ACV minus depreciation and your deductible, may be significantly less than the remaining balance on your car loan.
That means you, the driver, are still legally obligated to pay the difference to your lender. You could be left without a car and still hundreds or even thousands of dollars in debt. This isn't some freak accident of bad luck. It's a systemic outcome of how car financing and insurance valuation intersect. This exact predicament is precisely why a product called gap insurance exists. Gap coverage is specifically designed to bridge this financial chasm. If you have it, gap insurance covers the difference between your insurance company's payout and the remaining balance on your auto loan. Without it, that remaining debt stays firmly with the owner, an active liability even though the asset it secured no longer exists. It's an acknowledgement within the industry itself that the primary insurance coverage often leaves a significant financial exposure. Now, what if the accident wasn't your fault? If another driver caused the damage that totaled your car, their liability insurance should cover the costs. However, this isn't always the straightforward solution people hope for. Liability limits vary significantly by state and by individual policy.
If the damages, which include not just your car but any medical bills or property damage, exceed the at-fault driver's liability limits, their insurance will only pay up to that maximum.
In such cases, your own collision coverage or even uninsured or underinsured motorist coverage might still need to kick in to cover the remaining costs. The simple truth is, even when you're not at fault, the system doesn't guarantee a full, seamless recovery if the other party's coverage is insufficient. You could still be left in that familiar financial gap, navigating claims with multiple insurers, still potentially owing money on a car you no longer possess. Once the claim is finally settled and the payout determined, the mechanics are fairly consistent. The insurer typically issues a check directly to the lender to cover the outstanding loan balance up to the ACV. If there's any remaining amount after the loan is paid off, for instance, if you owned the car outright or had positive equity, that remainder goes to you, the owner. However, and this is the critical point, if the insurance payout is lower than the outstanding loan balance, the borrower remains responsible for paying the lender the difference. This isn't just a theoretical possibility. It's a common occurrence that leaves countless Americans grappling with an unforeseen financial burden. In America, a totaled car doesn't just mark the end of an accident. It can be the beginning of a profound personal and financial crisis, leaving individuals not only without transportation, an essential element of modern life, but also still saddled with debt for an asset that no longer exists. This isn't because of the crash itself, not because of some specific fault, but because of how coverage works, how actual cash value, depreciation, deductibles, and loan structures intertwine to create a system where the perceived safety net of full coverage can unravel, leaving its users exposed to an outcome they never anticipated. It is a stark reminder that understanding these intricate, often hidden mechanisms is not merely academic curiosity. It is a vital shield against the unexpected pitfalls that lie beneath the surface of everyday life in America. I'm Lucas Hale, and I explain how everyday systems actually work in America so you can understand the outcomes before they happen.